What's up, traders? Anthony Crudelli here, and thank you for tuning in to the Futures Radio Show podcast. Welcome to today's panel on how to analyze and trade this current macro landscape. On today's panel, we have Crescat Capital Portfolio Manager, Tavi Costa, CIO of Unlimited Funds, Bob Elliott, and the founder of EdgeClear, and otherwise known as Futures Trader 71, Morad Askar. Today's podcast is sponsored by EdgeClear. Futures Radio Show listeners can now trade at EdgeClear for a low introductory rate of 59 cents for most futures products and 20 cents for micro products and event contracts. Fund with as little as $100 and pair this with Sierra Chart's Teton order routing to receive one of the lowest all-in fees in the industry. For new EdgeClear members only. Check it out at myed.ge/Deli59. That link is actually down below in the description. If you're listening to this later in audio, it'll also be there on iTunes or Spotify or wherever you're listening to that stuff. Before I get the panel in here today, I want to remind all of you that Futures Radio Show podcasts are recorded and posted on iTunes, Spotify, and pretty much everywhere where you listen to your podcasts. And throughout today's live discussion, subscribers to the channel can ask us questions in the YouTube chat. So please take a quick second, if you're not a subscriber, and subscribe to the channel and hit that like button as I look forward to chatting with all of you throughout today's show. Now let me bring in this panel. Boy, I'm excited about this panel. We've got my buddy Morad, Bob, Tavi. This is a real treat to have all of you guys here today. It's going to be interesting to hear what you guys think about what's going on in the environment. Welcome to the show, guys.
Thanks for having us. Sorry.
Oh yeah, no, I know. No one ever knows whether to jump in, whether or not. We're
happy to be here.
I know we're also media trained now, isn't it funny? It's like we're in this environment now where I did TV years ago, and you had to go through like a media training before I went on there, and you get in there and talk for so long, and it's like now all of us have done so many podcasts. We've all done all of this. It's like everybody in the trading industry that's on these podcasts are like media trained to just wait and be patient and not to talk too long and to do all those different things. But we're going to get to a lot of stuff today. And what I want to do is, Morad, because you and I are definitely more on the technical side, they're on the macro side, right? And we both follow them on Twitter because their content's awesome. So what I want to do is I want to get what their thoughts are. I know we've probably seen a lot of stuff coming from them on Twitter as of late to the reactions to the latest Fed meeting. And I know that we're a little bit past that now, but I think it's really important to get their thoughts and see what they're thinking, because I don't know, man. I feel like that was such a critical time, and I feel like the market is still digesting that, right? I feel like the market is still trying to figure out what really kind of has happened here. So I think we maybe start with you, Bob. I know that we're going to hear a lot from Tavi about what the reactions were in gold and silver, but maybe we talk about what your thoughts are and what you thought the Fed did, raising by a quarter basis point with everything going on with banks and everything like that. And are they done maybe now? And how do you think that do you think that the markets reacted? I don't want to say correctly to what the Fed did, but what are your thoughts on how the market reacted to what the Fed said?
Yeah, I think in many ways, if we sort of take a step back in terms of where we are in this cycle, we're still experiencing an inflationary late cycle. We're experiencing the Fed tightening in response to those dynamics. Inflation still is above their desired levels, and what we've experienced in the last few weeks is a somewhat classic financial market, problem is maybe the best way to describe it. I hesitate to use the word crisis, but problem issue that emerged. And I think one of the things that it really immediately brought to my mind was thinking back to the 98 cycle, or to the late 90s cycle, where the meltdown of LTCM and the consequences of that more broadly created the Fed basically eased into that cycle, into those set of conditions. And as a function of that, what happened was that they re-accelerated the overall
the lesson from that experience was that that easing in a late cycle environment I shifted my mic. Thanks for the for the note. The easing in a late cycle environment when the macroeconomy is already relatively hot is a bad idea because it reinflates asset bubbles. And so that's really what we're seeing right now, I think, is the Fed learning the lessons from that experience, which is address the financial market problems that exist and ring fence those so they don't become systemic, which is what they did with their various policies and responses, but also don't forego what is necessary from a macroeconomic standpoint and the need to continue to tighten. And so that's really what we've seen. I think the thing that's most interesting right now is the market doesn't believe the Fed will keep tightening. We've got 100 basis points of 200 basis points of cuts priced in. And that is, the market is essentially pricing in a 98 response when the lesson from 98 was that was not the right thing to do. And inflation is much more persistent today than it was in 98. So that's kind of where I see the macro picture and the dynamics that are going on right now.
So you actually think that the market's pricing in those cuts, and part of me feels like I think that is what's keeping us from going lower, but I'm wondering in the back of my mind how much they believe it, because it feels like every rally just keeps getting faded. So it's like there's not this enthusiasm that rates are coming down, because I think there's more unknown to it, and I think part of it, just from my trader's perspective, just feels very much like it's just keeping us in a range now. Right? Like no one wants to be the one who sells into the break, and no one wants to be the one that buys into the rally. And I think that's what makes this environment. I put this out the other day. I think it is tricky for equities. Tavi, let's talk to you. What were your thoughts on what the Fed did? Where you think we are with the Fed raising rates? And I'm very curious to see what you thought about how gold reacted. And I think that gold's reaction lately is very interesting to me, because it seems as though a lot of times when there's weakness in equities, you see strength in gold, and the opposite happens when you have strength in equities, you're seeing weakness in gold, and you're actually starting to see gold become much more of a I don't want to say hedge, but it is definitely something where when you're seeing weakness in equities and you're seeing some of these reactions from the Fed, that people are stepping in, and they seem like you're seeing a lot of buyers in it. And so let's just go there. What were your thoughts on all of that?
Well, I think the last weeks have been a great reminder of this issue of the trifecta of macro imbalances that we're facing in the U.S. economy and other developed economies as well, which is the debt problem, the inflation problem, and the valuation problem in the speculative environment that we have currently. One of the things that is working very well since November, which we got a trigger from the percentage of yield curve inversions measurement that went above 70%, has been that gold to S&P 500 ratio. It's actually tracking its average return that usually tends to do all the way back to 50 years of data, which is quite interesting. I think that there's a real potential for both parts of that leg of that trade working over the next 2 months, given this need for central banks to always resort back to financial repression at some point. Now, one thing that is really in my mind, and would love to get somebody else's take on this as well, is what's happening with the Treasury cash balance. I can't stop thinking about this in the last couple of days, which, I think that the debt ceiling situation has been, over the last years, proven not to be a big deal, although perhaps this time it could be a bigger deal, not because of the risk of not getting resolved, but the other consequences of we might see occurring, given the fact that it might get resolved. So in other words, you get the cash balance right now in the Treasury at about $180 billion. The fiscal deficit alone for February was about $260 billion. So, they're very close to running out of that cash balance. But the real question is, once they do, is, there's some technicality and ways that they can be a little creative in ways of funding their operations in general in the short term. But ultimately, it goes back to issuing treasuries. And this was a concern of mine 1 or 2 years ago, was this flood of issuances of treasuries that we've had, which, yes, inflation was a risk. And you've seen this issue of more structural forces being priced in markets and causing 10-year yields to rise over the last 2 years or so. But to me, it was even further response of the mismatch of supply and demand implications of the large amounts of issuances that we've had. And if you see other times in history when we had this period of the debt ceiling situation not being resolved for a couple months, we can easily see a 500 billion or so issuance of treasuries just in the next couple months. You can make the case that it could be even larger this time, because the prior year when we had the situation, we did see a large amount of tax collection by the government, given the fact that we had such a strong year of asset performances in the prior years or so. And so there was a large amount of realized gains being posted in markets, and therefore the government was able to collect a lot of taxes as well. As well, you can think about corporate taxes being a huge part of that too. Now, after 2022 being one of the worst years for many assets, 60-40 portfolios, and it was a very challenging environment, it's hard to believe that the tax side of it will look very good and would be a support for the government. So to me, and if you look at the U.S. CDS right now, credit default swaps right now, I don't think there's a default risk per se. I don't think that's the question. The question really is, if we're going to have another issuance of treasuries, what does that mean to risky assets, or I would say risk-free rates, which everything is connected to that. And in terms of cost of capital, and how will the market really absorb that after seeing what we saw with 60-40 portfolios in 2022? To me, that's a very, very important question, especially when you have valuation of equity markets where they are currently. And we know the equity markets have not really been priced to this deterioration of fundamentals that we've had so far. In some parts of the equity markets, not everything has been fragile, but in some parts of it, we're starting to see the top line growth and bottom line growth beginning to contract in a significant way. So that's what is in my mind. That's all, I think positive for precious metals in the short, longer term as well. We've had a big run in gold, and so it wouldn't surprise me if we had a pullback in the following week or so. It would actually make sense. I sort of hope it does, because I believe in the long-term story, and I obviously have a different investments in that camp as well. But anyways, so that's sort of what's in my mind in terms of the macro landscape. If somebody has a take on this treasury cash balance, I'm all ears.
I think before we get to you, Morad, I want to talk to you about some things as well. I think we got to go to Bob and just see what he thinks about that.
Well, I've spent more time in my life than I like to admit on the debt ceiling matter, particularly 10 years ago. And so I'm following it closely. I think one of the places, just also for listeners who just want to keep an eye on what's going on, there's a resource, the Bipartisan Policy Center. It provides the best coverage of the facts and figures related to the debt ceiling and the possible X date. And I think what they highlighted in a report that was a couple of weeks ago was an update of the path of getting to that debt ceiling, noting that the expectation right now, because of a variety of different seasonal factors, is a reasonably significant drawdown in cash. And what we've seen so far, this sort of a couple $100 billion drawdown in cash, is expected. That was expected seasonally, given the spending. But I think the real ambiguity, the avenue through the end of March in the next couple of days is pretty narrow, and we're sort of meeting that. I think the real ambiguity is, what do those tax receipts look like, right? Because those tax receipts, which are really, going to come in the first 3 weeks of April, and it's a little confusing because tax date's a little bit later than normal in the U.S. That's really the open question. And so I think, we really got to stare at that, because that's the difference between hitting the debt ceiling before the expected end of June payments versus hitting it meaningfully after the expected June quarterly payments by entrepreneurs and others. And so I think that's really the question. So we're gonna know a lot in the next couple of days. I think Tavi's broader point, which is, look, we're gonna get to the debt ceiling. My guess is, it's going to get resolved in one way, shape, or form. I mean, or it's going to be a hell of a mess, and that we'll deal with that if that happens. But probably it will get resolved painfully by others. And what that means is a bunch of debt issuance in the back end of the year, in order to refill the coffers of the Treasury government account. I think that's a very compelling point. I think a very important point, and one which sort of adds to what feels like a pile of different things that are lining up for risks to the economy and asset prices in the back half of the year, whether it's, the roll off of student loans, the restarting student loan payments, the roll off of the CHIP and other measures and transfers to lower income households, whether it's the amelioration of the previous benefit from higher nominal tax brackets to lower nominal tax, through the year as that catches up. Like all of those things, it just feels like there's like one thing after another that's lining up in the second half that could present a real risk to the economy and to markets. So I share with him that intuition, particularly around the debt issuance side of things.
It sounds to me as though you guys are in the recession camp is coming at the end of this year.
Yeah, I mean, I think a recession is coming. There's no question about that. And the Fed will not meet, it would be, everyone dreams of a soft landing, but it never happens. So let's not pretend like soft landing is anything close to probable. I mean, it's damn near impossible, right, to get a soft landing. And so given that, and given that we have these inflation dynamics that are still present and look increasingly entrenched, how do you resolve that? Is you have to have a slowdown in spending, which leads us to a slowdown in profits, which leads to a slowdown in labor markets, which leads to a slowdown in wages, which leads to a decline in inflation, in earnings, which leads to a decline in inflation. And so like that has to happen. So it's coming. The question is more a question of when, as opposed to whether if it will happen. Probably, it's going to happen. It seems like, I don't know. I mean, I've been saying beginning of fourth quarter for like a year now. That's kind of my median expectation right now. I don't know, Tavi, if you got thoughts on that. We also don't have to monopolize this conversation too. So between Tavi and I.
No. Well, quick thoughts. I mean, I think the earnings side is where I'm really focused. I mean, there's, you talked about the inflation issues. It's structurally wages and salaries as far as relative to profit of corporations is still, very, I guess, historically lows and starting to rise. And I would expect that to rise even further and pressure margins to be squeezed. And you have the cost of capital issue, which regardless of what the Fed does, I was talking about this dynamic of the Treasury market, because it will have an impact at some point in fixed income markets, and especially in the risk-free rate and the cost of capital itself. The third one is this logistics of what's happening with the deglobalization trends that we're seeing, which certainly add to the pressure of margins again, with things getting more costly, this sort of almost end of the cheap labor era of really importing cheap labor from places like China. And the fourth one is the material costs. I mean, things have somewhat come down in depending on what costs you're referring to in terms of materials, and but things are bottoming in my view, and historically elevated levels. It's not like things have really come down. And so for a company, margins are a challenge. And so if you look back in 70 years of earnings, there's a channel of earnings per share that you can look at in the S&P 500, and we're right at this critical juncture at the very top of this channel, which suggests that maybe we're closer to something like a earnings recession, and would make complete sense with all the macro data and the indicators that I think we're all looking at. And so I'm concerned about that, because that questions multiples, and multiples are very frothy still, in my opinion. I think investors are still conditioned to a place where you invest in low cost of capital and high growth, which probably won't be the case in the next 5 to 10 years, in my opinion.
I want to bring Morad into the conversation here now. Morad, you and I, we're not the macro experts here, but it's so interesting listening to them, right? It really gives us insight as to what's really happening in the markets. And I think that's what we're trying to achieve here today, right? Is get this trader audience, an investor audience, to understand what's happening in the backdrop and make sense of it, right? And of what's happening in the marketplace. you and I have been doing this a long time. Look at this environment right now. We heard from Bob, we heard from Tavi. It's hard for me to disagree with anything what they've said, and we see how it's spilling over into the markets, and this environment is really not really that easy for traders. I know some people on Twitter may say it's pretty easy, but I feel like it's difficult. What are you seeing in the marketplace right now, and maybe taking in some of the information that they have? Is it making more sense as to why we're trading this way?
I'm happy to sit and spectate and watch these guys talk for a while. It's not a problem. I mean, some of these threads that Bob does is just like scroll, read, scroll, read, scroll, read. The trade itself, and just to put it into context, I mean, I'm looking at day trades only. And so I'm looking at very short-term movements. It's been tough. It's been pretty tough. So those people who say this is a piece of cake or whatever, I can see that perspective if I drop back into, where you and I started, which is to scalp these markets. There are a lot of scalping moves. But from a structured point of view, it's tough. That I'm seeing no follow through. Even when there's a break, it just breaks very quickly and then just trades sideways. I'm talking about the indices here. We've seen that in crude. Crude has been rallying lately. Some pretty nice, crude's been moving a lot better than the indices. Again, futures are not suitable for all investors, but so manage your risk. But overall, I'm not seeing very good follow through on a lot of classic kind of auction market or profiling setups. Yesterday is a perfect example. So we had a Monday that pushed up in the S&P. Then yesterday, as expected, it pulled back into Friday's range. And then it tested the prior month's low by like a couple of ticks. We went to last month's low by a couple of ticks in the S&P futures, day session only. And then today, we are 50 points higher than that, 60 points higher than that on the open, skipping through all of Monday's trade, which makes very little sense to me since I didn't see anything in the news that was really that fantastic. So I think we're in a holding range. We're trading around this highly, highly traded, highly accepted area in the S&P in the 30 to 44,000 area. Lots and lots and lots of volume has been transacted in this region, and that's how I look at the market in terms of volume profile. But the trade, to answer your question, has been really difficult. I find myself wanting to do other things, run other businesses and things like that, than to stare at the screen like I usually do all day long.
And talking to you, Bob and Tavi, I mean, this is why I love these conversations. Like I said, I mean, for me, I have been really getting chopped up. It's like a good day, a bad day, a good day, a bad day. And I know that you guys aren't trading it on the short-term level like we are, but that big picture spills over into the intraday. That's just reality, right? The big picture always supersedes the short term. And so I go to you guys and say, so I understand you guys gave us pretty much the landscape of what you guys think is going on right now. What is the trade then? Where is the moves to where traders or investors can feel like it has potential legs, where we can actually get behind a market and say, look, we feel like this has some directional stability, right? I mean, crude oil doesn't have it. I think gold actually does have it right now. Equities, we know, just doesn't. What are your thoughts on that from that bigger picture perspective, where you think is really the recession trade, maybe I call it? Maybe we'll start with you, Bob.
Yeah, I mean, I think this is a hard, like, frankly, on a short-term basis, I think this is a very hard market to trade. I was sitting there listening to Morad talk about trading intraday, and it gave me anxiety at the thought of having to trade intraday, given the uncertainty that exists in this market, and given, frankly, how thin it seems to be trading in terms of just like how big we have we have relatively large asset moves, price moves on relatively, small incremental information. And so, I think one of the things, we don't talk about it too much in terms of what we do, but at Unlimited, a big part of what we do is we use technology and we see what hedge fund managers are doing in close to real time. And I think that the overwhelming outcome of that process is that there's a lot of uncertainty, and managers are super de-risked right now, basically running the lowest leverage that they have in 25 years, other than like the acute part of the financial crisis. And I think that really speaks to what's going on here, because we don't really know exactly where the break is going to happen. Like, look, if there's a recession that starts to emerge 6 months from now, it's going to take a long time to get between today and 6 months from now, right? And there's going to be a lot of countervailing forces, and I think on top of it, the uncertainty of whether or not this SVB thing is meaningful in terms of a problem or not. You know, my guess is it's not meaningful in a big picture level. My guess is it won't derail the expansion, but that's a guess. That's not, you know, that there's certainly no certainty about that. And so we're left with strategic, you know, sort of a longer term tactical set of questions about when exactly is this all going to play out, and then a shorter term, you know, do we have what's in place to create a downside break right now in terms of the economy? All of that adds up to a lot of uncertainty, and all of that adds up to, frankly, running low risk and not making too much of a bet on any one particular outcome for the time being, you know, which is hard. I think the main place where there is some opportunity is in those, you know, Fed fund futures, maybe in the December 23s or the early 24s, which are pricing in essentially 100% risk of a crisis or close to it. And, you know, a crisis may come as a result of this SVB thing or other things that emerge, but 100% looks a bit overstated in terms of the probabilities. And so that's a place where, you know, if you had to pick and choose where you were going to go and where those sort of risk return profiles look good, that's really what looks the most interesting to me right now is shorting those Fed funds out, you know, 9 to 15 months.
Let's stay there for a minute. And I'm pulling up the CME Fed Watch tool because this gives a great perspective into what Bob is talking about here. And if you look at, and I look at this all the time, and if you go up to January of 24, which is, it seems like it's, oh wow, we just got into 23, Anthony, but not, however, it's April in a couple of days here, so it's not that far off. And you've had a Fed that's been raising rates, and we're talking about that all the time. How far will they go? Will the Fed continue to raise rates? Are they going to keep rates up here higher for longer, right? But then when you go to CME Fed Watch tool, which I watch all the time, you go out and look, and the target rate by January is 400 to 425 basis points. I mean, you're looking at 100 basis points of cuts between now and then. And it's just hard to believe that the Fed is going to shift that much. And really, this is a short period of time in the scheme of things, right? And you even go to June of this year, which is that's only 2-3 months from now. It's looking for 475 to 500. July, you're looking at still 475 to 500, and September 450 to 475. So they're saying by September we're already seeing rate cuts coming into the market. And so, Bob, what you're saying is for that trade is because these are all the high probabilities. What you're saying is that maybe it takes longer. Explain why even me ask the question. Explain by looking at this how people could go in and what that trade is.
Yeah. I mean, the opportunity, I think, is to sell maybe the December 23 SOFRs or Fed fund futures, or maybe even out if you go out to next June. I like next June, 15 months out. I think you see even more cuts that are being priced in. You know, that's 350 to 375. That's a hell of a set of cuts in 15 months, where, you know, it could happen. I'm not saying it's impossible, but when you think about markets and you think about, particularly in the macro space, what you're looking for is bets that are slightly tilted in your favor, right? And so the probabilities here of this outcome seem meaningfully lower than what's currently priced in. A much higher probability of big cuts is priced in than I think would be the reality, both in the combination of the fact that we're likely to have we're not likely to have a crisis market action relatively immediately that would cause those initial cuts. And then I think the second thing, which is important to remember, is like in inflationary cycles, the Fed typically only starts cutting interest rates 9 to 12 months into like the recession, the initial moment of recession, right? Okay, well, that would be starting to cut because they got to fight inflation. They want to see inflation die. And we're a long way from seeing inflation die from the Fed's perspective when they, you look at the overall core measures and things like that. And so I think the combination of the lower likelihood that this will create an acute crisis plus the inflationary problem, you put that together, it seems unlikely that you're going to see these outcomes.
Tavi, we've got this up here. What are your thoughts on what Bob is saying?
I would tend to agree. I think there is we're not doing this in our macro fund, but I think there's a potential for a trade on expecting rates to be higher for longer and fading the cuts. But especially given where inflation, and I think if you have a view that you might be entering a secular inflationary period, which I am of that view, I think there's a point to be made where perhaps you could the rates market could be incorrect in that expectation. As far as investments that you asked earlier, as far as what are the most interesting investments in this environment, I still find really attractive to be looking for opportunities on the long side of owning tangible assets, and especially tangible assets related businesses relative to shorting in general or hedging that long position with shorts in long duration assets. And I think there's baskets of those maybe sub-macro themes within those ideas. On the short side, the three buckets that we've been very focused as far as short positions have been, I still think corporate spreads have to blow out significantly if my view plays out. And so I still think they're very cheap, and especially in the junk market, even investment grade as well. If you look at historically, you would expect credit spreads could be trading, 2 to 3 times what they are currently, if we do have more of a credit event unfolding. Number two, I think there's also a lot of risk in private equity. I think the mismarking of treasuries in the banks and other fixed income mismarkings that we've seen so far recently in assets and their balance sheets also question some of the tech startups and other investments and even office real estate and some others that a lot of the private equity companies have done. We've been doing a lot of work there in terms of analysis of which ones we would think that are the best candidates and could potentially suffer in this next months or so. It's a hedge on the long side of the portfolio, but I think some of those look quite attractive. Number three which is one that I think is very contrarian, as I think a lot of people disagree with this. I think mega caps look really appealing as a short. I think they're the definition of a long duration asset, in fact. And if the environment that I'm thinking plays out, especially with the pressure from the situation with the treasury markets, potentially we have yields rising in the long end or something along those lines, but that could change, or create a whole repricing of those assets in a big way. And I think there are some of those equities that are extremely frothy. The median PE ratio currently for some of those companies are still in the high 20s, believe it or not. And again, I don't agree with those valuations. I think we can certainly protect that side of the portfolio. Those are more macro bets on the short side. I would say the long side is long-term investments that we have done by acquiring properties or companies that own properties or creating our own companies and looking for natural resource deposits. We've partnered with the geologists recently in the last 2 to 3 years. We launched a hedge fund solely focused on that. It's almost like a hybrid venture capital approach, but in a natural resource space with a huge focus in metals and mining. And that has been doing very well. I think there's a lot of inefficiencies in that market. I don't think it's just a capital trend. I think it's a labor trend. that allows us to exploit those inefficiencies, given the fact that a lot of people don't understand that market very well, especially in the exploration side, which requires a lot of geology knowledge. So I'm really excited about that. I think it's a very asymmetric way of being long gold, which doesn't sound very exciting, being long gold, if you're looking for asymmetry. But buying natural resources in the ground is a lever way without actually using leverage to take that trade in the long term. Obviously, you have to have a view, more of a secular view, because you're dealing with small cap names and you're dealing with lower liquidity. So that's the trade-off that you have to understand. Oil markets look very oversold, in my opinion. I think there's great opportunities there. A lot of companies that still look really, really cheap, historically speaking. Some of them have never been cheaper. And Brazilian equities, they've been suffering recently. I think there's also a lot of opportunities in the Brazilian equity market, given my views about the commodity space. And so those are my my ideas and investment side currently.
Oh, thank you so much for sharing that. What we're going to do is we're going to take a quick second here, and we are going to give away 2 iPads today, something that Morad and I have done over the past year. Isn't that cool, Bob and Tavi? Well, we've worked together. We know that the trader audience always is tuning in for us, and so this is something that we do to give back to them. And Morad, I'm going to hand it over to you. 2 iPads today. I kind of wish I was on that list. I always like getting a new iPad. So talk to us about what we're giving away and who the winners are.
Yeah, so today we're giving away 2 iPads, 10th generation. We don't want to take the time to spin the wheel here because we all sit around twiddling our thumbs. So we actually do it ahead of time and record it. The winners today are Kurt and Jess, Jesse. I don't know if that's a Jesse or Jess.
Dang it.
Yeah. And the 2 runners up, in case Kurt and Jess are not able to participate, are Walter and Alessandro della Corte. So those are the winners, Kurt, Jess, and runners up, Walter, Alessandro della Corte. We'll please make contact. You'll be reached out to today by the EdgeClear staff, and then to make arrangements to get those delivered to you.
Awesome, man. I want to remind everybody, you can go to edgeclear.com/deli. Why deli? That was my badge on the floor. Most people know me as that. It even says it under my name on here. People don't know what that means. I'm not pitching a sandwich shop, but yeah, you go here every month. We do it, and we will be giving something away again next month as usual. And you can go here and sign up, and all you gotta do is fill it out, and we give them away throughout the show. So go to edgeclear.com/deli, and pretty much everything that feeds into Futures Radio show that we're doing with EdgeClear is on that page. That link is also in the description and also in the audio if you guys are listening later on audio. And congrats to the winners. That's an awesome gift. So let's go back to what I want to do. Is I want to just pull up a quick chart here on gold, and I actually want to get into oil as well. Obviously, we're gonna talk with Tavi a little bit more about gold, but I want to go to you first, Bob, and bring you back into this. What are your thoughts on the way that gold has been acting lately, the response to the latest Fed meeting and everything that's going on in this environment?
Yeah, I mean, I think my framework around gold is to think about gold as a combination of it's money with no yield, and so it often will trade, when quoted in fiat terms, it'll trade on the interest rate moves, right? The lower the interest rate earned on fiat money, the higher the gold often will go, and the opposite. But it's also a hedge, and more of a strategic hedge against tailed outcomes. And so I think what we've seen recently over the course of the last couple of months is, we've seen undulations that are connected to the moves that we've seen in the bond market. But I think that can miss, frankly, and even those sort of day-to-day wiggles can really miss the fact that if you look at gold over longer-term time frames, I mean, even let's say since the beginning of 2022, gold is doing great at a time when asset markets have done quite poorly. And I think in a lot of ways what that is, it reflects the continued pricing and risks that we get tailed outcomes here. Tailed outcomes either meaning, too much tightening and a deep recession, or not, what I think is probably more likely, which is slow to tighten, inflationary pressures build up and emerge and exist for a long time. And so that's what I see with gold. And I think in a lot of ways, I think given the heightened tail risk that exists, gold still looks like a great opportunity here, given the risks that exist and the fact that it is a very diversifying position for most investors in their portfolio.
Yeah, Morad, we'll talk to you a little bit about it as well. I mean, I know that you and I aren't out there day trading gold as much, but I know that you and I are both watching it all the time. What are your thoughts on the action you've seen in gold as of late?
Listening to Bob here kind of renews my sense of faith in gold because, I mean, if you pull up that chart again, just to tell you my perspective, gold had a really nice run, quite tradable run, in fact, from about middle of 2018 all the way through the start of the pandemic. And it put in a high at the start of the pandemic, somewhere around 2089, 2090 in the futures. And really hasn't done, like, if I had bought it somewhere on that run, by the time, some trigger goes off on a momentum trade, I might have gotten into that at 1600, maybe 1700. And I'm watching this thing rip to 2089 and then pull back to 1600, then go up to 1800, then go to 1900 and back again. And here we are trading at 1965 after breaching the 2000 handle a couple weeks ago or last week. It tends to just sit sideways and really test your patience. I mean, if I was a gold investor, it's a lot of like twiddling your thumbs and then just your hair getting ripped off your head. As you can see, that's happened to me quite a few times.
Not me, though.
And then it sits sideways for quite a while yet again. So I always wonder, why would anyone want to hold this thing in their portfolio? Because it's inflation has gone up quite a bit. Gold has ripped up, so that's expected, a hedge against inflation and so on. But since then, man, if you are a gold only fund, a gold only CTA or gold only fund, Bob, what would your performance numbers look like, on a 1 year, 3 year, 5 year, 10 year basis? Would that be
way better than holding 60/40, right?
Is it
way better than holding bonds? Right. That's the thing. Yeah. We get on here, we start talking about gold. I'm sure, Tavi, this is really your area of expertise, but I feel like we get on here and we start talking about gold and people start to look at me like, I'm out of the 19th century, like a real weirdo, and it's like, okay, let's have a conversation about the portfolio construction aspects of gold. Like, over the last year, over the last 5 years, over the last 10 years, over the last 25 years, this century, like, gold would have been meaningfully beneficial in your portfolio. How about since the 90s? How about since the 80s? How about the 70s? Like we're talking about an asset that is structurally beneficial to your portfolio. I agree that it goes through these periods of strength and weakness that, at times can feel annoyingly boring, but like the big picture story from a strategic perspective is this is a good asset to hold in your portfolio that does very well in tailed environments, and over the course of the last 50, 75 years is a good asset to be holding in the book.
Of course, we got to bring you in now, Tavi. And I know that you talk about a lot of different other ways to participate in, being long gold in the portfolio, right? But obviously for this audience, we've got a lot of people that are out there and they're kind of junkies like me and Morad, where we like to come in and we like to trade this stuff, right? And we don't necessarily, I have it in my investment portfolio as well too, But I think for us that want to go out there and trade it, it's always good to have some idea of what's coming behind us to help support it, right? I mean, gold is different than trading the S&P, because to me, the S&P is just really built way more on technical analysis, when gold is not something I really look at and to say is really, it's going to go up or down from here, almost really based on the chart, right? There's a theme behind it that you want to have, and for the direction that you're going to be in, and specifically long. So what's the story for wanting to be long gold right now?
Well, I agree with a lot of the comments, and some of the critics of gold are fair critics. And I think, look, ultimately, I think you want to be looking at this trend of central banks having to improve the quality of their international reserves. And I do think that's a real trend. And back in the 70s, I've been talking about this for a while, but back in the 70s, the gold relative to international reserves ratio was closer to 72% at the peak, actually, but it was in that range of about 70, 60% or so for a long time. And now we're below 20% in that ratio. Knowing what's happening with the fixed income market, especially the treasury market in developed economies, on the sovereign bond market, but also the risk of inflation and this geopolitical tensions happening, which gold is certainly a neutral asset that has that that favorable side of it. I think that is where the real demand starts. Number two, which I think it's incredibly important, is looking at the supply side of it. We've had really two great bull markets for gold in the last 50 years, in the 70s, in the early 2000s. And there were a lot of independent drivers that really forced those bull markets during those times. In the 70s, you can say maybe it was an inflation hedge. Currencies began to float more freely. You've had all sorts of issues geopolitically. In the early 2000s, you've had China entering the WTO. You've got the tech bust. And some other problems, especially actually with the rise of the commodity super cycle at that time as well, which was a move towards tangible assets, where a lot of producers of commodities did very well. But one thing that actually happened during those two periods was a secular decline of global production for gold. And they also had their separate reasons during those times. And one of them, is well, in the 70s, there was issues with interest rates. It was very difficult to do that. Today, we're starting to see this global production declining. If you look at most of the major companies, the Barricks and Newmonts, I call them the dinosaurs. I mean, they're aging businesses. They have aging assets, essentially. They haven't been investing in new production stories. They haven't been investing in new projects. They haven't developed a new project in a very long time. And they're returning more capital to shareholders and investing in their own businesses. This is the first time this happened in over 30 years, by the way, to this degree that we're seeing currently. Buybacks from gold companies, have you ever seen that? Dividends to the degree that we're seeing currently? Add the two and look at that relative to history. We've never seen this before to the degree that we're seeing currently. So, with gapbacks, so we know that for especially the top 10 majors is at really depressed levels. And so we're not seeing any of that reinvestment happening in the space at a time when institutional capital is really chasing the green revolution. So battery metals are getting more attention. And so it's forcing a lot of those companies to turn away from gold-only projects and move towards gold and copper projects, rather than gold and silver projects. And so you're seeing a big change. And in fact, Barrick has one of the largest copper exposures that we've had over, I think, in the history of the company, for instance. And a lot of those companies are doing that. So there's a lot of things, a lot of takeaways. How do you invest in this environment? What I'm doing essentially, but I think that the majors will do okay in this environment, because if gold prices do well, essentially they will do well. It's like oil markets when everything became uninvestable, when you had the issues with oil prices going negative, and the green revolution started really to heat up all this the talks that we've had over elections in 2020 and so forth, was really when oil turned, when oil had one of its best, or actually its best 2-year performances in 2021 and 2022 in over 30 years, right when everything became uninvestable. And so, it's important to note that there is a potential for that to happen the same way in the mining space. And one thing we noted recently, because the oil market is important to point out, because it's one part of the commodity market that has been in a more of a, I would say, a structural bull market recently. And if you look at and backtest the factors that have really been working for investors in that space, it really has been companies that are increasing production, and companies that have been actually reinvesting in their businesses through CapEx and so forth. Not the companies that are returning large capital to shareholders through buybacks and dividends. The difference in performance between the two is tremendous. I mean, some of those is over 40 to 50% spread between the two buckets of companies, if you look at those metrics. And so you're starting to see the same actually happen in the mining space. The mining space, if you look at the top 50 companies, and if you separate top 10 versus bottom 40, you're going to see a drastic difference between the two. Top 10 are extremely disciplinary. Bottom 40 are in investment mode. Their CapEx is back to record levels, believe it or not. Yes, they're much smaller in nominal terms than the top 10 companies, but you're seeing a completely different environment within the industry. And if you look at the performance between the two, not the GDX versus the GDXJ, look at the actual performance of the top 10 versus the bottom 40, you're not going to see a major difference. In other words, the market is not penalizing companies for being aggressive in the commodity space, which is really interesting. And so, I think this is going to be a new narrative where investors are going to start really rewarding companies that are being aggressive, that are improving production, that are investing in high quality assets, that are not what the majors are, which are currently just aging businesses, as I mentioned before. And so I think that's going to be a lot of changes in this industry and a lot of opportunities. And in my view, the biggest opportunities would be in the high quality assets in the exploration and development phase of the industry.
You're muted.
I thought you guys could read my lips, man.
I thought you said I was muted. I was about to.
Oh, that was.
Imagine if Tavi was muted to the whole thing.
Yeah, that was like the best segment of this whole thing was there. So
Sorry, Tavi, we didn't get any of it. Tavi, how can we find those top 10 versus those bottom 40? Is there an easy way to do it? You talked about those companies.
Well, so the top 10 versus bottom 40, I mean, it's just looking at the overall market cap, just rank them. And it's easier if you do US and Canadian companies in the Canadian and US exchange, because you're going to get majority of the major companies, the largest companies in the world, and you're also going to get enough data. It's very hard to analyze data from, Chinese companies. It's hard to believe in some of the production numbers that we see. So we don't invest in that, in those markets, but even Russian businesses as well. But you're, in Canada and the US, you can get very clear data, and you can look back. You can look at the fundamentals of, revenues, for instance. A chart that I've been looking at for a long time is just looking at the revenues for most of the major companies, the top 10 businesses, and you can see very clearly that they've been stagnant. There hasn't been any growth whatsoever. And the real issue that I think most people in the industry kind of understand, that people outside of the industry don't understand this. It's not the existing reserves of gold. The quality of those reserves have been deteriorating drastically. If you look at the average grade of those reserves, they've been in a secular downward trend as well. I hate to use the word secular again, but it literally is. It's been in a decline since the 07, 06 times. And so, we're not, when was the last time we've seen a major high quality, high grade discovery in the gold space? And we haven't seen this since the 90s, really. And so I think it lacks excitement. It lacks, it's a perfect recipe for an investor, I would say, like myself, that is looking for something depressed with a lot of inefficiencies. And don't get me wrong, there's a lot of issues with this industry. There's a reason why they're trading at the levels that they're trading. they've been, total capital bleeders. They've been spending capital, deploying capital in things they shouldn't have deployed. They've done M&As at the times that they shouldn't be doing M&As. This is the story of the mining industry. It's one of the oldest industries we have in history. Although it really thinks, if you look at even the number of geologists entering the space, there's a lack of those folks as well. It's very difficult for us to really build new businesses because there's not enough people that have that level of expertise. Even the CEO of the companies we invest, we know they're not, a powerhouse CEOs. I'm sorry to say that, but we're aware of that, and we got to work with them and try to unlock value through what we do in terms of our expertise on the geology side. But again, it's very tricky. It's a market that I think it's very different than the technology space and other industries in terms of valuations. Everything is priced for failure already. And so, but investors can buy the top 10 major companies. They're not terrible businesses. There are, they have consistent free cash flows, and they're probably going to be forced to come into the exploration businesses at a higher price. I can tell you that one of the themes of the conferences and the meetings that I do almost daily is that what's happening is the new theme is that the majors are really starting to engage with our core holdings, meaning the companies that we do have that are already with, somewhat successful in the exploration side. So there's an M&A starting to, I think, to unfold in this space, which could trigger, a lot of positive things in this overall industry. The bottom 40 are quite attractive. I mean, those are all companies that are usually in the development phase, about to become producing businesses. I think if you are not in the geology world, which is my case as well, I think you want to be focused in that part of the industry. I think there's a lot of opportunities there as well. There's a lot of financially savvy people that will navigate that space as well. And given the fact there's a little less, the more exploration you go, more geology you need to learn, the more development and production you can apply financial models to understand those businesses a lot better. So, that's really the tricky side. So I think anyone can invest in the space if they would like to.
I think for us, Morad, on the trading side of things, I'm looking at more of investments myself at this point versus like trying to go in and trying to figure out exactly what's going on a day in, day out basis. I think it's just not a market that's super easy right now, as we've said for the day traders. We said it even gave Bob anxiety, and Bob doesn't look like a guy who gets too anxious too often, right? So what we're going to do is we're going to end on a couple things. Number one is, Morad, do you have any questions for the panel before we let them go?
I don't know that we covered housing that much, and that's something that impacts everybody. And I know that's probably another hour of talking that we don't have. But we're in an environment where the housing numbers aren't great. But man, I look around here, Chicago, and it doesn't look like anything's coming off all that much. Units are still moving. Chicago is not one of the hottest markets in the country, of course, compared to whatever. Texas, Florida, and so on. But briefly, maybe in a couple minutes, where do you guys see that? How do you see housing, say, by the time the Fed starts cutting rates? Where do you see housing at that point?
Yeah, we'll go to you, Bob, and then I got a final question for Tavi for the day.
Yeah, housing, I think one of the things that people forget about, because it's been a long time since we've been through a housing cycle, is housing is very slow moving. Like super slow moving. Like if you go back to the 2008 cycle, like the housing confidence peaked in like late 2005, and we didn't get a crisis until 2.5 years later, right? 2 years later or 3 years later. And so I just think it's important to recognize that housing cycles take a long time to play out. We are actually pretty early in that stage, right? Confidence has gone down, transactions have gone down, but actually when you look at things like things that are typically the next things to fall in the context of the macro economy, which are things like construction employment and related real estate employment, that actually hasn't gone down yet. And the reason why that is there's a lot of pipeline activity, a lot of pipeline construction, particularly in the multifamily space. that is meeting the needs of the secularly low housing supply we've seen in the last 15 years. And so, we're just in sort of the beginning stages of this whole cycle. Like, where will we get? Probably 3 or 4 years from now, if we continue to have relatively elevated interest rates, which I suspect we will, certainly relative to history. We're probably going to see housing move down another 15-20% on a national level. To be clear, that would put us mostly back to just pre-COVID levels. That's not that crazy to assume that we would have a correction in prices that way. Those declines are probably going to be concentrated in the areas of the biggest previous gains. Already, we're seeing big divergences between West Coast housing prices and like Northeast housing prices, right? West Coast are collapsing, and Northeast prices, if you look, you'd say not much is going on. So that will probably, the places of the biggest booms will be the places of the biggest busts. Will be down, to levels that are pre-COVID levels. And it's going to take a long time for that to meaningfully resolve the price imbalance, but also meaningfully affect the real economy. And so, I wouldn't, if you're betting that there's going to be a recession now based on the housing market, you're going to be pretty disappointed. So I've been saying it for a year, but you're still going to be pretty disappointed given how slow moving it is.
Thanks for that, Bob. And somebody who's lived through those times, I agree with you. It's one of those things. It takes time. It doesn't just say, oh, all of a sudden housing's crashing. My wife does a ton of business down here in Florida, and she is now slowly starting to see some things peel back, but it just doesn't operate the way that we think of as traders or, even investors. When you look at markets, it's not going to move like the price of the S&P.
The housing market is like the antithesis of a day trading S&P trader, right? Like those are like two totally different, like it could not be more opposite of each other.
Yeah, we're like, oh, they're going down. Well, it's going down tomorrow, and it just takes that time for that to happen. Final question for the day, and we'll go to you first, Tavi, and I want Bob to answer it as well. But it's really a quick question. We saw a lot of people talking about this in chat. And I think when we bring this to a close today, because we did talk obviously a lot about gold, and the question is, what should I own? Should I own physical, gold ETFs, or other? If you just had to pick one, and let's just say for the next several years, I don't want to put it in a too long of a time frame, but not too short, which one would be the best one to own?
Wow. That question is impossible to answer unless you have a notion of understanding of risk of that investor and what profile he falls in. But
true.
I think if you ask me, the safest trade across that, I think is just buying gold itself. I think buying physical gold is interesting, but I'm not necessarily a gold bug, believe it or not. Although I'm in the gold space, it's not necessarily my view that that's the best way to be deploying capital is to be owning gold in physical market. I think if you're looking for something also relatively, I wouldn't call it safe. It is certainly very volatile, but that has a better degree of or a better potential return. I would say silver is quite attractive. It's hard to believe you're going to have a bull market for gold and silver won't follow. Now that's quite interesting as well. But I just want to say this again, that's not where I think the real opportunity is the fact that everyone thinks that gold and silver and so forth, everything is maybe old era and so forth, and no one wants to focus on that, is that what creates the opportunities in businesses that are smaller that no one is paying attention to. And so do I think that's going to be the same level of inefficiency 5 years from now? Honestly, I hope not. I hope, we're able to exploit those inefficiencies over time. But no, I don't think will be the case. And so I think capital markets are, in a way, efficiently in terms of chasing those opportunities over time. So I think at some point people will realize the opportunity in this camp. But you asked me a tough question. I don't know how to answer. I think.
Let me rephrase the question, because you're right. I don't like the question myself either. I think let me make this a simpler way, right? If you wanted direct exposure to gold, just the price of gold, what's the best way to buy it? Is it to buy it in an ETF or is it to buy it in physical? I think that's a simpler way.
I don't think you have any issues buying in the ETF. That's my 2 cents. If you got two options there, yeah, I wouldn't mind buying on the ETF, GLD. I think that's a fine instrument to own. I don't think you're going to have any issues. I don't own it. I just want to be very. I don't own the ETF. I'm not taking that risk. I haven't done the due diligence if that's an ETF that I should own. But you asking me today with the level of knowledge that I have, I think it's an okay instrument to own. And then, yeah, that's the question. That's my answer.
Yeah, what I like about the ETF is that, I own the ETF, but you could sell it that easily, right? I mean, I don't know how easy it is to sell gold if you actually had it physically. I'm not somebody who would even know that answer. So I look at it from the perspective of if you want direct exposure to gold and you want to be able to get out of it if it's at a certain price.
Well,
isn't that some part of it? Like at some point you're trying to turn it back into dollars. That's unless you're just owning gold to have gold because you're looking for the apocalypse, right? I mean, I don't know why I would have physical. I always wonder why people say that.
The interesting thing is that they're, developed economies in terms of cost of capital is really high right now relative to emerging markets, relative to some emerging markets. You can get loans in businesses in emerging markets, especially in Latin America, not too far from what you get here in the US. That's crazy. That's insane. I don't think we've ever lived an era really that close of a spread between the two. Depending on the place, you can get an interest rate of 6-7% to develop a project in the gold space. Yes, you carry more risk in that country, but that should be reflected in the interest rate as well as far as risk goes, and it's not being reflected. And on top of it, you can take the debt in local currency terms too. To me, that's a no-brainer, but there's no such thing as a no-brainer. I shouldn't say that, but yeah. I think that's an interesting proposition for investors to be willing to take that risk and build businesses in those. I understand that's not your question, and that's not what most of your traders and investors will do, but that is a scenario that is currently the case in Latin America versus developed economies today.
Bob, we'll go to you for this question. Like we said, I think it's interesting, right? If you want to have direct, if you want to follow the price of gold directly, and I think some people put out there, the spreads are too big for physical, and that's kind of what I anticipated. That's not something I've ever done. If you buy gold, you're probably going to pay up for it to get the physical. And then when you go to sell it, you got to find somebody who actually wants to buy it. And that spread alone, I don't know how you take advantage of the price action versus just clicking the button and buying and selling. What are your thoughts on physical as an aspect or being able to have access to gold versus the ETF?
Yeah, I think I've long held gold in my personal strategic portfolio on the order of 10 to 15%. I've only held it in ETF form. I think that I appreciate the concerns of the fact that, ETFs have a bunch of different risks associated with them. Frankly, the biggest risk in holding an ETF is fraud, that the gold is, been lent or is not in the vault when people expect it to be there. To be honest with you, things have come a long way in the last 15 years when it comes to 15 to 20 years when it comes to the auditability and the reliability of these instruments. They're also being run by, world-class institutions. I think, the ETF is good. There's some nuances when you get into what ETF to hold, where you might find certain things more efficient, like IAU. GLD is the name. It is also the most expensive and the most tax inefficient. So you might enjoy a better, lower fee structure with IAU, or to the extent that you don't want to do K1s, IAUF is an interesting option as well. So, that's, there's also lots of other options. I just sort of rattle those off as possible ways to do it. I always like to say, if we're in a world where you need to think about what physical gold you're holding in your basement, like, man, we got lots of problems.
Exactly. At that point, I want commodities for gold anyway.
And like maybe the guns and the water is probably more important.
Exactly.
To be holding in that circumstance than it is the gold.
Having been through hurricanes, I will tell you this, and it's where the town is completely shut down and everything. You still, the most important thing always is going to be commodities, food, water, gas. I mean, because when you're in a town that's inoperable, everybody would be willing to switch you any sort of money you have to get water or food or gas. Those things are the most valuable without question. If you're talking about completely losing technology, like I said, being in South Florida, I've learned that firsthand. You're like, man, it don't matter. Even you got, people with a lot of money, they'll pay through the nose just to get a tank of propane. Right.
Yeah, I mean, not all of us experience sort of those third world conditions of South Florida.
That's how I got to keep my.
But then again, that's why I'm pasty white, and you're,
Yeah, he's got those.
You got a nice sheen there. So.
Yeah. And by the way, what's the transaction cost of breaking up a gold bar? How much do the?
I mean, exactly?
What do those crumbs cost you?
They go, you got that gold coin. I'm like, yeah. I mean, so anyway, I got to tell you guys, this was exactly what I anticipated in a conversation like this. Talking about things that are really, impacting the current macro landscape and how to analyze it and trade it and invest in it. And just, you guys gave us such a great sense of what's actually going on here. And I can't tell you how much I appreciate it. I always learn something from you guys, whether it's on Twitter or in person. So we really appreciate you guys being here. And everybody out there in the audience today, just want to say, remember, Morad and I get together every month. We get to bring in great guests like this. I encourage you to go to edgeclear.com/deli, sign up, and continue to just get involved in the stuff that we're doing, get on the list, and get involved in the giveaways. And, we've been doing this for a year now, and it's just a whole lot of fun. And we would love to have more and more of you participate. So if you're listening to this, we highly recommend you go there and check this out and learn more about even what EdgeClear is doing. They're doing a lot of great things, and everybody that goes there ends up coming back to me saying, Anthony, thanks for recommending them. It's been great. Bob, Tavi, we will see you guys on Twitter. And of course, everybody, all of their links will be down below in the description. If you enjoyed this show, please give us that like button, retweet it, share it, put it out there, and definitely go and follow Tavi and Bob on Twitter. Two of the best. Not only are they best in the macro, but they're just great guys, as you can see that today. And I appreciate you guys sharing the time with us. Morad, until next week, next month, my friend.
Thank you, guys.
Thanks for having us.
Thanks, everyone.
It's great.
Cheers.
All right, everybody. See ya. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudelli.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudelli.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudelli Productions.